we detected an unusual trade worth $61 million on DoorDash stock, ticker symbol DASH. But here's what makes this even more interesting. The stock has fallen from its 52-week high of around $285 to about $202. That's around a 30% pullback. And the last time we analyzed this stock was back on this day, May 9th, as it was also pulling back. But you might have missed it unless you were subscribed to our channel. So we bought this dip along with our members and rode this big move all the way up from that pullback until those unusual options we analyzed expired on this day, September 19th. As you can see, the stock gained around 45% ever since our first trade entry. This was our video analysis back then that we shared on our channel, where we showed the data behind why we were going long bullish on DoorDash. On that day, when the stock was pulling back, many people were selling out of fear. They were hesitant to buy, but we followed the data, not our emotions, specifically call options that expire September 19th, worth about $105 million that appeared just before the stock reversed higher. That's what allowed us, along with our members, to stay calm, trade with confidence, and make better, smarter decisions, just like the smart money. And it paid off. That options trade turned out to be very profitable, gaining over 100%, much more than the stock's 45% gain, because call options gave us more leverage than simply buying shares. So if you want to see exactly how we did this using our own deep research-based approach with data-driven analysis, we'll link this video up here. Make sure to subscribe and hit the notification bell so you don't miss out on these very profitable opportunities. Now, our trade already expired on September 19th near the 52-week high. So let's analyze the latest data from unusual option activity to see how a wealthy investor is trading DoorDash, especially since it's now pulling back again. Are they bullish and buying the dip, expecting the stock to bounce back up, or bearish and selling, expecting it to move lower? Because as we all know, the rich have more access to exclusive research and information, sometimes even leaked insider information, giving them an edge to make better, smarter financial decisions. This is how smart money always stays one step ahead, well before the rest of the market catches on. No wonder the rich get richer. And so, to level the playing field, let's dive into the unusual option activity to gain insights from the rich so that our subscribers and members can profit from this deep knowledge too. As we can see here on the options time and sales tape, there was unusual option activity on November 19th at 11:43 a.m. at the 10-second mark in these November 21 options at the 240 strike calls and the March 20 options at the 180 strike calls. A quantity of 51,000 contracts were being traded in the November 21 options, and 15,000 contracts were being traded in the March 20 options. Now, these November 21 options are about to expire. So what's going on here? Well, based on our deep analysis, this wealthy investor was closing out of these November 21 options and rolling into a new trade at a later expiration date. This means that these March 20 options at the 180 strike calls are the new opening trade, and these contracts were being traded at a price of $40.75 each. So we can calculate the total cost of this new trade by multiplying the number of contracts traded by this price per contract. But remember, options are priced per share, and each options contract controls 100 shares of stock. So to get the actual dollar value, we multiply by 100 or simply move the decimal 2 places to the right. That means each of these contracts costs $4,075. And so when we multiply this by the quantity of contracts traded, 15,000, this equals a total trade cost of approximately $61 million for this unusual option activity. But keep in mind, just because a trade is large does not necessarily mean it has a high probability of success. In fact, this one carries more risk than the smaller, more selective trades we share on our website. And so, if you want to get access to those lower risk trades with a higher probability of profit, then go to our website. We'll link it up here. And if you join the membership through our website instead of YouTube, you'll also receive additional trade alerts by email because YouTube does not share your email address with us. So if you want more opportunities to profit, make sure to join the membership through our website. Keep in mind that our members also get earlier access to trades like this before anyone else, even before we share it with the public. So if you're tired of being late and want more time to act on these opportunities, just head over to our website, where you can see exactly which stocks wealthy investors are trading on Wall Street and when they're doing it, so that you can have the same opportunities as the rich. Because if the rich get richer, why shouldn't you? With that said, even though this trade carries higher risk, we still took it, but we used position sizing to manage our risk. As we can see here on the option chain, for the March 20 options, we also bought these 180 strike calls and entered the same position here, marked as POS, with the green color indicating a buy position. And notice how the open interest now shows those 15,000 contracts opened by this wealthy investor. Now, keep in mind, some of these new contracts could be other traders jumping in as well, including ourselves and our members, which is why the number is slightly above 15,000. But the majority of these contracts were opened by this wealthy investor we've been tracking, the one who bought these 180 strike calls at a price of $4,075 per contract, the same price as we saw earlier on the options time and sales tape. And so when we analyze this trade, we can see here on the risk profile graph where the profit or loss shows up here, and the x-axis represents the share price of the stock, which is currently trading over here, and the y-axis represents the amount of profit or loss. Note the zero break-even line over here. And so when the purple line, which represents the current date, and the blue line, which represents the option's expiration date, are trading below this zero break-even line, as the share price goes down, this trade becomes more negative, more loss. And as the share price goes up, this trade becomes more positive, more profitable. In other words, this trade is going long bullish on DoorDash stock. We can also confirm that by checking the options Greeks. This trade has a positive delta, which means it's positioned long and bullish. If it was a short bearish trade, we would see a negative delta instead. But keep in mind the risk with this trade. It has a negative theta, which means it loses value over time due to time decay. And that is why you can see here, the purple line drops down lower to the blue line as we approach the option's expiration date. Since these options lose value through time, the break-even on this trade moves higher as time goes on. And so you can see here, even though the call options we bought have a strike price of $180, the stock needs to trade above $220 per share for this trade to be profitable at expiration. But remember, even if the stock does not break above this price, we already locked in a lot of profits from our earlier trade on DoorDash, when those unusual options at the 165 strike calls expired on September 19th. So if you want to see that winning trade analysis we shared on our channel when we bought the dip here, we'll link the video here. For deeper access to our strategies, visit our website. We'll link it here. As always, please like, subscribe, and until next time, let's keep tracking the trades of the rich so everyday investors can profit too. Take care and have a wonderful day.